Welcome to the Security Economics Podcast. I'm your host, Peter Harrell. We are recording this episode on April 2nd, the one-year anniversary of Trump's Liberation Day tariffs. And boy, has a lot happened over the last year on American trade and tariff policy. In order to talk about all those developments, I am thrilled to be joined today by Greta Peisch, who is a partner at Wiley, Rein, and who served as general counsel to the U.S. Trade Representative's office in the Biden administration. And then I'm thrilled to welcome back Brad Setzer, the Whitney Shepherdson Senior Fellow at the Council on Foreign Relations. We're going to have a really interesting conversation looking at what had happened, what we might see in the year ahead. We were recording this before some recent news on pharmaceutical and steel and aluminum tariffs, so while we get into that a little bit at the end, we did not cover that in detail, maybe for a future episode. Nonetheless, I think it's a really interesting conversation about the trade world that was and the trade world that will be coming. With that, let's get to the podcast. Brad and Greta, it is great to have you on the podcast.
It's like a reconvening of the early Biden era.
Yeah, thanks
I don't
for
know if
having
that's good marketing for this.
Sorry.
No, but it's really great to have you both on. We are recording this on April 2nd, 2026, on the one-year anniversary of Liberation Day, where Trump rolled out his universal and reciprocal tariffs, imposing tariffs of generally between 10 and 20% on a whole range of America's trading partners. And boy, has a lot happened since then. I look forward to both unpacking what has happened there and also where we may be headed now. But just to kick off the discussion, I thought, Brad, I'd ask you to offer some thoughts as we are here at the one-year mark of Liberation Day. What do you think the economic impacts of the last year of tariffs have been?
Well, I think the interesting thing was they didn't turn out to be universal tariffs. That was the marketing. But the actual tariffs exempted about 50% of non-oil trade. USMCA exclusions, pharma, maybe not after today, semiconductors, computers. So they ended up not being universal, which is, I think, important for thinking about their impact. They didn't end up being quite as high as was announced on Liberation Day, when some of the tariffs were, 40%. And their overall impact a year later, as the policy was implemented, turned out to be probably more muted. If you look at the increase in the effective tariff rate, it was an increase of about 7.5%. Roughly 10% of our GDP is imports. So the just pay it cost, since this is the effective tariff, not the announced tariff, that is the government revenue, was about 0.75 point of GDP. The increase in consumer prices is of that magnitude, generally is estimated to be between 0.5 point and 1 point increase in the price level. The fall in GDP relative to baseline, so the slower reduction in growth, is probably between 0.25 and 0.5 point. So real effects, but not giant effects. What the tariffs didn't do was radically change the overall pace of growth in global trade, which was reasonable last year. They didn't enormously change the overall U.S. trade deficit, although there was an important set of shifts within the trade balance. And then it didn't reduce the growth in China's surplus. China's surplus went up another $200-300 billion last year. So on one level, it was a giant change in policy, no doubt, highest applied tariffs ever, threats of massive tariffs, but the aggregate economic impact was relatively muted, more muted than we expected on Liberation Day.
And how much of that do you chalk up to, as you said, the tariffs actually turned out to be less universal than maybe was originally signaled? How much of that do you chalk up to the tariffs actually being quite a bit lower or smaller, certainly in terms of scope coverage, than originally expected? And how much of that do you chalk up to the underlying resilience of the economy and the fact we're driven by other economic factors?
I don't know, like half-half. Certainly think the fact that we did not tariff USMCA trade, except when in a few isolated cases where Greta can explain why you couldn't qualify for the USMCA exclusion, mattered. It really mitigated the impact. The fact that, essentially the growing part of the economy, the whole AI sector, all the inputs into AI, all the computer equipment needed to train models and the like, where imports have gone up a lot, was entirely excluded from tariffs. So we didn't hit that. All that, I think, did matter. The honest truth is that if you just had a 10% across the board tariff, or basically a 1% tariff, you would not expect giant impacts. You'd expect some slowdown in growth, some reduction in the fiscal deficit because it's a tax, some upward adjustment in the price level, but not catastrophic impacts. And so what we ended up with was not the catastrophic, in some cases prohibitive tariffs that seemed possible on Liberation Day. And we didn't end up with the easy to implement 10% across the board tariff. We ended up with this sort of weird outcome of 15 to 20% tariffs on some things. Like household goods ended up being quite heavily tariffed, and no tariffs on other things, including the tariffs that might have slowed the most dynamic parts of the economy. So as a result, yeah, you didn't have giant negative impacts. I guess the other factor that played in here was briefly we did really have these crazy high tariffs on China. They reduced from crazy high to just very high, and now they've come down even more. But the Chinese companies that were selling to the U.S. had ample time to prepare, and in general had set up factories in Southeast Asia to do final assembly and get around the more prohibitive levels of tariffs that were in place last summer. And that also mitigated the impact. So when you kind of combine excluding AI and computers, the USMCA exclusion, and the ability of imports that were formerly coming from China to be rerouted through either Southeast Asia or Mexico, you get much more modest impacts.
Greta, I want to bring you in. What are your takeaways from the last year of Trump tariff and trade policy?
Well, I mean, I'm obviously not an economist, but I would agree with Brad that there was a lot of holes that grew in the sort of tariff wall over time. And it's sort of, but from a political perspective, looking at all of the criticism of sort of the sky is falling, we're going to have runaway inflation, did seem like it was getting ahead of the story of where we were. And I think in addition to all the things that Brad said, with the delays in tariffs coming on and off, you also saw these surges and spikes in trade, trying to get ahead of tariffs, trying to get ahead of tariff increases, and then drawdowns in warehousing. And a lot of sort of gaming the system as the administration took steps or forecasted that they were going to take steps or took tariffs off and took them down over time. And that really dampened the impact of the tariffs that we've seen. I think one thing that I've been thinking about and keeping my eye on is we haven't really had new tariffs, and maybe that will change very soon, since like third quarter of last year. We've had threats and we've had statements that they're going to happen, but really we're lower, than we had been today because IEEPA was overturned and now we're at the 10% across the board. And so we've kind of been in this sort of combination of decreasing and sort of status quo, and that's kind of where we are today.
I think that's a really interesting point. Now, starting sort of September, October of last year, we didn't really see new tariffs. If anything, we saw kind of additional small exclusions coming into place. There was the additional food exclusions. As Trump sort of finalized a couple of the trade deals, we saw some additional products potentially getting excluded as part of some of the finalized trade deals. And I think it was just really interesting to see, sort of 4 or 5 months of really a lot of new tariffs. And then the last 4 or 5 months, it's been quite a bit quieter. I want to come to you, Greta, in just a minute on some of the trade deal elements, which I think is the other really interesting part of this. But one more question I want to put to Brad, which is for the next year, do you think we will see a lower trade deficit than we did in, say, 2024 before we began all of this tariff, all of these fundamental changes in our tariffs?
No, but it's not really because of the tariffs. It is because if things go as people expect this year, we're going to have an enormous boom in investment in data centers. And it turns out that building a data center is very import intensive. And even with the balance of payments 122 tariffs, there is an exclusion for semiconductors and for computers. So right now, I mean, if you just do simple math and take imports from January of computer equipment and project them forward for the year, the trade deficit just from that alone grows by $200 billion. So we've just had this enormous surge in equipment of imports related to data centers. I mean, it's rare that one sector drives an economic outcome, but in this case, it clearly is. And, the funny thing last year, I mean, first of all, two things I want to note. One is that I loved your analysis of the ratio of Trump tariff tweets to actual tariffs. That was brilliant. And it turns out the hit ratio, I don't know if you've done it over time.
I got Bloomberg. No, Bloomberg, after I started tweeting about this, did a whole systematic study, and it was a 73% non-follow through rate across
and it feels like that non-follow through rate has gone up. I mean, where's the 15% 122 tariff that has been threatened at least 5 times? So, I mean, that was really brilliant. But the other thing is, and this is just funky, and I don't know how any future historian or economic historian is going to sort this out. But the biggest swings in month-to-month trade came from pharmaceuticals and gold, unambiguously. You did see a run-up in consumer durables ahead of Liberation Day, and then you see a fall. But huge swings in pharmaceutical trade, huge swings in gold. And at 1 year later, we still don't have tariffs on pharma. They may come, but I think there's going to be a lot of exclusions. And they've decided not to tariff gold. So you end up having the wild beat the tariff effects for 2 high value added products, which are easy to move, which in the end were not tariffed. So it was anticipation of tariffs that didn't happen.
One more question for you, Brad. What about on the manufacturing front? I mean, there's obviously been a lot of press coverage about the fact there were 100,000 manufacturing job losses last year. There were also manufacturing job losses in 2024, if I understand correctly. There'd been a bit of a decline then, too. On the other hand, we have seen a ton of announcements of new investments in manufacturing in the U.S. Where do you think we're headed on the manufacturing, both manufacturing output and manufacturing employment?
I mean, the safe forecast on manufacturing employment is that it's going to kind of be stable. There's a bit of a drop, but there's actually been a stabilization of manufacturing jobs over the past 7 or 8 years, not largely because the trade deficit has swung, but because, and this is sort of weird, but manufacturing productivity hasn't grown. So the typical driver of job losses in manufacturing is higher productivity. I mean, imports can play a role, but I think we've been shockingly stable in manufacturing employment, in my view, for several years now, and I expect that to continue. Manufacturing output, it would be a little bit surprising given the AI boom and given all the investment in semiconductor fabs that is coming online, if that didn't push up manufacturing output just a bit. Hard to attribute that, in my view, entirely to the tariffs. Trump will claim credit for it because of the deals. I think the Biden administration can fairly claim some credit for it because of the surge in investment tied to the CHIPS Act. But, that should drive something. What is, to me, interesting, and I've been looking at this reasonably closely, is that in these sectors where you actually see lower levels of imports, where you might think the tariffs would have an impact on manufacturing output, in general, you haven't seen an increase in U.S. domestic production. So the best example is autos. Autos imports are clearly down in real terms for reasons, they were pretty heavily tariffed. U.S. domestic automobile production is not up. It's actually down a bit. The same is true for furniture. Imports are down. U.S. furniture production is not up. You can argue there's a small increase in steel production, but it's actually not that big relative to the giant 50% tariff. So the main impact of the steel tariff has just been a shift from consumers to producers. I don't think you can say the tariffs as of now have generated a substantial increase in manufacturing output, in part because of how they were designed. I mentioned earlier, we ended up with really high tariffs on household goods and on clothing, largely because of the way the tariffs were put on South and Southeast Asia. And those are just not areas where there's a lot of U.S. production. We had pretty hefty tariffs on auto parts coming from, this is the one area where Mexico and Canada weren't excluded, and hefty tariffs on metals. So the cost of aluminum in the U.S. is super high relative to the high global cost. All this makes it more expensive to produce a lot of goods in the U.S. So the net effect, in my view, has been pretty close to a wash.
Greta, I want to shift directions and talk some about what I see as the other really big, really interesting thing that the Trump administration did last year, which was strike something on the order of 20 preliminary trade agreements. I think we're calling them, what is it, RTAs they're calling them? ARTs, agreements on reciprocal trade, of which 7, if I remember correctly, we now have final text for, pretty detailed, probably 50 to 100 page documents with countries including Argentina and Taiwan and a couple of Central American countries, as well as Malaysia and Cambodia. I'm interested in what has been most interesting to you about the trade deal agenda.
I think it's been interesting that it does feel like a high level, almost kind of, you could say, watered down version of a trade agreement, right? They are long, but they're not as long as a free trade agreement, as a comprehensive agreement. So in some ways, it was interesting and surprising that they cover so many different topics, that they talk about, cooperating in non-market economies, which is China. They talk about digital trade, they talk about technical barriers to trade, and some of these kind of more wonky topics. And I feel like it kind of reflects what I think of as a 2-track trade policy, where one track is the president and the tariff policy on kind of a macro level, and investments, which he's very interested in, which are also a part of these deals often, not always, depends on the partner. And then the kind of the sort of more worker bee of trade policy implemented through USTR and commerce, where they're trying to address some of the typical trade issues and irritants we have with these partners. And I think a question is, given that kind of bifurcation, how do the enforcement of the agreements play out over time, and how, what's their kind of life for the rest of this administration and after?
What do you think are the big wins from the administration's perspective in the agreements? I come at a lot of this from a national security, international economic background, and I have to say, well, I have questions on how they'll be implemented. If I read the text of what a country like Malaysia or Cambodia has agreed to, it seems quite impressive. But I'm curious what you think the big are in the agreements.
Yeah, I mean, I would say that it is pretty impressive that they convinced some of these countries to take commitments that make it sound like they'll cooperate in confronting China, because that is something that many of these trading partners do not want to do, because China is a very important partner for them, a very economically significant, as an investor, as a customer, as a supplier. So that is a real thing that is interesting to consider what that means for their relationship with China and how they view the sort of US-China competition going forward. Because just even making that statement, I think, is a big step. But I think as for the rest of the concessions, I think it really depends. For a large part, we haven't seen implementation. We haven't seen the United States ask any of these countries to do anything vis-a-vis China. Many of the commitments are really just words on paper right now. And so I think it's a bit of a to be determined as to whether we get a lot out of this as far as results over time. Maybe the part that you can see whether a country has implemented, and it's a bit more black and white, are reductions in tariffs. And we have seen some of those happen, but again, not all of them. And every country has their own domestic process to undertake. But I think the EU, as it was moving its tariff reductions forward, it actually put an expiration date at the end of the Trump administration for those tariff reductions. And that could be extended, but it's a signal that, this is an agreement that many of these countries view as with this administration. And I think it's an open question as to what the arrangement, if any, will be with the next administration.
Yeah, I was also struck by the fact we saw that the EU Parliament add this expiration date to the EU's implementation of the trade deal, which is going through. And I do think there's going to be a really interesting open question post-Trump, whether it's another Republican president, Vance or Rubio, or whether it's a Democratic president, how they will want to change the deals, but then also what our trading partners will be looking at to renegotiate some of the commitments that they may have made. And I do think that'll be an interesting space to watch. While I'm on the topic of what foreign trade partners are doing, Greta, I do want to ask you just briefly, what did you make of the WTO conference last week? I mean, it was interesting to me that Ambassador Greer went to the WTO ministerial in Cameroon with a pretty robust set of opening positions on how the U.S. would like to see WTO reform. Obviously, there's some frustration at how the WTO ministerial came out, but I'm curious for your takeaways from watching what we saw play out in Cameroon.
I think it was heartening to see Ambassador Greer go, but I think it wasn't surprising because the administration to date has seemed to be open to and actively engaging at the WTO. The first deputy USTR that was named and confirmed was the one that sits in Geneva. They paid their dues, some of the back dues at least, to the WTO. They've put in several papers now about what they think reform would look like. And they're seeing some positive responses from other members. You had the EU put in a paper on whether MFN, sort of the principle you treat all members essentially the same, is the way to move forward. And seeing some movement in some of these issues as other economies think about the impact, I think, of China and its trade balance with the world, not just the United States. And so I feel like they feel like they're getting some traction on some of these issues, and that a good, offense at the WTO is a good strategy for them on the global stage right now.
I want to come, Brad, to you to ask if you have anything you want to add on how foreign partners are reacting to these deals. Also, you mentioned at the beginning in your economic analysis that China's overall global exports have not come down. And how do you see U.S. trade partners dealing with the new global trade realities?
The quick answer to how U.S. trading partners are dealing with these new realities is unhappily, and nowhere more unhappily than in Europe. Unhappy because they felt like they were coerced into an unreciprocal deal where they lowered their tariffs on the U.S. while the U.S. raised its tariffs, and then unhappy because they believe that exports that China otherwise would have sent to the U.S. have been diverted into the European market. Now, I think the reality is that China's exports to Europe were going for reasons independent of U.S. trade policy over the past few years, and they would have gone up no matter what U.S. trade policy was, just because of the dynamics around China's auto industry, the dynamics around China's chemical industry, and, frankly, the fact that the yuan, China's currency, is incredibly undervalued against the euro. And so European production is just suffering across the board. But the Europeans feel very put upon. I mean, it was very noticeable, I think, that most countries did not retaliate. China was the exception. And most countries concluded that what they cared most about was not having a much higher tariff than their neighbor. Once Japan and Europe accepted 15, everybody kind of converged around 15 and didn't fight the 15% tariff under the reciprocal deal. Now, okay, that got torn up with IEEPA, but it was interesting from a negotiating point of view that people cared intensely about not having a higher tariff than their neighbor more than about principle. And then the other one, which I think everybody's going to be looking at as an example, is that, China did retaliate. It retaliated quite effectively. It retaliated asymmetrically, including with export controls, not just by limiting U.S. Its purchases of U.S. goods, but it did its usual playbook around not buying agricultural goods, not doing Boeing orders, et cetera, et cetera. And at the end of the day, the perception is that China forced the U.S. to walk back the tariffs. And certainly compared to the Trump campaign pledge of roughly 10% across the board and 50% on China, even before the IEEPA ruling, China had negotiated an outcome that was much better than, you might say, the campaign baseline. There is a little bit of buyer's remorse, I think, on some of our trade partners about the deals they struck last summer when it looked like, Trump was hell-bent on higher tariffs no matter what the cost. And when the example of China's retaliation and the ability of China to use that threat of retaliation to get the U.S. to walk back some wasn't so fresh.
Just a quick follow-up on that, Brad. Do you think we need a higher than today tariff on China if we want to continue to push diversification in U.S. imports away from China and to other trading partners?
Simple answer is yes. We got a roughly 10% tariff on China now across the board. And then in some products from the legacy 301 case that Greta and I worked on extensively, we have much higher tariffs. But, trade has shifted away from those areas. I think in general, 10% is not high enough. China, most people will just pay it. And then I think it is too easy to get around a bilateral tariff. So I would say either everyone else needs to join us in higher tariffs on China, which would be the best outcome, or we need to find a way of tariffing embedded Chinese content. Because the parts in some ways are where we have the most security type vulnerabilities from the security economics point of view. We care much more about the embedded chip than the location of final assembly. The permanent magnet and the rare earths that go into the permanent magnet may be more important than where you put the permanent magnet into an electric motor. And I think the same is true with precursor chemicals for pharmaceuticals or precursor chemicals for batteries. So if you care about embedded dependence and supply chain concentration, you can't solve that problem with a one country tariff on China.
The president is expecting to go to China for his rescheduled summit with Xi on May 14th and 15th. My understanding is the Chinese have not actually confirmed that date yet, but we all seem to be looking at a mid-May summit. I'm interested in how you think the U.S.-China trade relationship is going to evolve over the course of this year coming out of the Xi-Trump summit.
Well, it's hard to predict in part because, like in many things that President Trump does, it is personality driven and driven by his relationship, his view of the balance of power. But the way I perceive where things are is they really are in a holding pattern. I think that the administration thinks of the deal from late last year as a pause. It was a 1-year pause. It is a time that the U.S. is taking to try to, as much as it can, address some of the dependencies and vulnerabilities in supply chains with respect to China. A year is not going to do it. These areas of critical minerals, magnets, rare earths, they're so complex and embedded. It's, we're not going to be able to do that. But I think that they do view it as really a stalemate in a relationship that could escalate at some time in the future. Maybe it'll be a year, maybe it'll be an extension of the pause. I think the thing that we hear rumblings of out of the administration and even the president himself talking about investment from China, which would be really kind of a stunning development. As in the last administration, where there's a lot of controversy and very limited openness to investment from China across a range of sectors, and kind of a growing sense of what sectors are sensitive for national security purposes. And so, that's something I'm really going to be watching, is whether as a part of those discussions, there's talk of investments, announcements of investments, because that would really be a change in the U.S.-China relationship that would bring about a lot more complexities from, I think, a sort of national security and strategic competition perspective. It would really kind of change how the playing field would be between the two economies. And maybe it won't happen, but I think there's at least been enough of it coming up to make me wonder, is that going to be a part of the discussions going forward?
That's a very interesting point. I mean, as you say, in the Biden administration, there was a deep skepticism of, for example, letting Chinese car companies open up factories or even just battery factories here in the U.S. But we do hear these rumblings that Trump may be more open to that. And I agree that that's going to be a really important piece to watch. Brad, curious if you have anything to add on what to expect on U.S.-China trade this year.
It seems possible given that Trump hypes these investment deals like they're the greatest thing since sliced bread and talks about how they're making our economy so hot, even though in general they have no substance. And, I note for the record that the Saudis made a huge investment pledge, and Saudi Arabia is running a current account deficit financed by issuing bonds. So they really aren't in a position to actually substantively deliver on that without borrowing a ton of money. The one country that really could throw a ton of money at the U.S.
Brad, I just have to stop you there. They seem to have canceled their ski resort in Saudi, so maybe
I know. So maybe they're going to build one in the U.S. I mean, the Saudis are actually in a bit of budgetary hurt, and people do not understand that they are no longer wallowing in petrodollars, whereas the Chinese are genuinely wallowing in dollars. I mean, before the oil crisis, you could see that Chinese state banks were adding $100 billion a month to their foreign portfolio. China can finance really big investment deals. So you can see why Trump is sort of attached to that. But if you do that deal, you're kind of embedding an unbalanced relationship. China gets a surplus exporting to the world. It throws it back into the world and ends up in the U.S. We sustain the imbalance. And I can't see how it would be in the U.S. interest to allow Chinese automotive semiconductors and batteries into the U.S. through the back door, which is what happens if you do a final assembly deal. But, you never know. So I think I agree very much with Greta. This is going to be super interesting. The other one is going to be purchases. I mean, I think, one of the interesting things we're seeing is that China actually pre-committed to buy a lot of LNG as a liquefied natural gas as part of its earlier deal with Trump. And some of those contractual commitments are now coming online. The export capacity has been built. The trains are in place. They're taking delivery of a lot of LNG, and then they've become kind of the central bank of LNG because they can produce electricity at home with coal. And so they are selling LNG to those who are short LNG in Asia left and right. So, I mean, just because China takes delivery of a cargo of LNG, just because it commits to buy, it may help you finance LNG capacity expansion, but it doesn't mean that China will take delivery of the LNG. So I think that's just sort of an interesting side bit of how this purchase commitment has transformed China into a really big player in the spot market for LNG in an energy crisis.
Well, I do now want to pivot to the legal issues. I'm sure everybody listening to this podcast has at least a general sense that in late February, the Supreme Court found that the law under which Trump had imposed his Liberation Day tariffs, this 1977 emergency powers law, did not authorize tariffs, and there's now an issue around refunds, which we might come to in a moment. But the other thing that's been happening since that happened in late February is that Trump has been using a couple of statutes to try to recreate the tariff regime under other legal authorities. So I was wondering, Greta, if you could just unpack for the audience a bit, what are the legal authorities that the government is using, and how are they staggering them, and their kind of new constraints the government faces as a result of having to use these other legal authorities?
Sure. Well, the very day that the IEEPA tariffs were struck down, the president signed an order, put in place these Section 122 tariffs that we've already referenced. This is a statute that's never been used before, which is a story we have seen with the Trump administration using new tariff authorities. That was the rationale, and Brad can talk more about whether this is justified from his perspective, is to address the balance of payments crisis, and came out of the time when these transitioned off of the gold standard in the wake of that adjustments that happened then. And this authority allows it's called a surcharge, so basically a tariff of up to 15% for up to 150 days. So it's limited in time and in the amount of tariffs. And also, and I think we've seen that the, administration is interpreting this way, it requires parity across countries. There is flexibility to remove products and to remove countries if they're not contributing to this, to the balance of payments imbalance. But you can't have sort of the IEEPA structure, which was, 10% on many countries, 15% on some, and then 19 and 18 and 25 and all of the different numbers we had out there. So everybody is currently at 10%. And that's what was put in place at the start of the use of this authority. And as you said, the president and others have said it will increase to 15%. We haven't seen that happen yet. And you can sort of speculate the reason why that hasn't happened. We had agreements with some countries that we would cap the tariffs at 10%. The UK and also Argentina, many of the countries we actually had, either very low trade deficits or trade surpluses with, were at 10%. And we had agreements that kind of memorial that level. And so we would come out of compliance. We would also be out of compliance with the EU and others where we had a 15%, but that was the cap of the sort of MFN baseline tariff plus the IEEPA tariff. So that could be one reason, is that, they've sort of looked again at whether they can distinguish between countries, apply different tariff levels to different countries, and concluded that is really putting us at a lot of litigation risk. Also, we saw that the day that the Supreme Court decision came out, that they announced that they intended to take other measures to permanently recreate the IEEPA regime using, for example, Section 301, which was the authority used in the first Trump administration to put tariffs on China. We've now seen a couple sets 301 investigations launched with respect to 60 countries in the case of excess capacity and overproduction, 60 in the case of import bans on forced labor, and 16 in the case of excess capacity and overproduction. That statute requires an investigation of the practice that's alleged, which involves notice and comment to the public, and then a proposal of a tariff remedy, which again requires a notice and comment stage. So that together would take at least that 150-day timeline that 122 tariffs are in place. So it seems like the administration, they have a Band-Aid to immediately do something to at least partially replace the tariffs, that IEEPA tariffs. And then they have a longer term plan of a more durable measure, Section 301, and more exactly replace the IEEPA tariff regime that they had set up.
First of all, let me say thank you very much for that analysis of what the Trump administration is doing on fallback tariffs. I know that the Section 122 tariffs are being challenged by some of the same litigants, I think, who brought the challenge against the IEEPA tariffs, some of the same state governments and a group of small businesses. I want to come to Brad in a minute as to whether you think there is a balance of payments crisis. But first, I want to ask you, Greta, as a lawyer, and realizing we are all staring at the crystal ball, and this is a statute that has never been used before, and thus, by definition, has never been litigated before. If you have any guesstimates on how that litigation is going to proceed?
Well, it's at the starting line still. It's at the Court of International Trade. But I think this is a harder hill to climb than under the IEEPA tariff challenge, because the question there was, does IEEPA at all even authorize tariffs? It didn't say tariffs. It was an interpretation of the language on regulating importation. And the Supreme Court ultimately said, no, it doesn't say tariffs. Tariffs are not allowed. And that was the end of the story. The litigants didn't get into, and the court didn't address whether there was or was not an emergency. I mean, that wasn't even challenged. And the thinking there was an emergency declaration is something that really courts leave to the president, right? And so when I think about 122, I kind of think of it in that framework. 122 clearly authorizes a tariff. Again, it calls it a surcharge, but that's what the executive order says. It says we're going to impose a surcharge. And then the question becomes, well, is it this kind of balance of payments, imbalance, crisis that is described in the statute? And I'm not sure, again, if that's the kind of question courts want to get into. Congress did not do a lot to define what that is in the statute. Courts, I think, are not well equipped to answer that question. Certainly, I feel like I am not. I'm a lawyer. I think someone like Brad is. And they gave that power to the president to decide when that emergency is. And it's a pretty confined power. It isn't something that can go kind of spin out of control, like I think the court saw happen with IEEPA in their perspective, where tariffs could be as high as the president declared for as long as he did so. This is max 15% for max 150 days. Congress already put other guardrails on the use. And reading more restrictions into the declaration of the conditions for the surcharge may, not be a place that the court wants to go. And, they've sort of done it once with APA, and this is an easy case to distinguish from that.
Brad, and also recognizing, I think you and I during Bank Fund Week in a couple of weeks are going to be on some sort of panel about this, but do you want to preview a little bit how you see the economics of whether the U.S. has a balance of payments problem?
You're not going to, obviously the two high-paid, best trade lawyers in the world won't let me opine on the law without a law degree, which is what I actually would normally do. Because when you read the statute, it says an international payments problem. The framing sentence doesn't necessarily define that in any way, and of which a balance of payments deficit can be an international payments problem. The issue, I think, for the law is that, as Greta said, there's no definition of what a balance of payments deficit is for the purposes of this statute. So will the courts want to get involved in it? I agree with all that. Now, there's an interesting conceptual debate about whether the U.S. has an international payments problem right now. And there's also a conceptual debate about whether the U.S. has a balance of payments deficit right now. In the 1960s, a balance of payments deficit generally was probably defined as a claim on your reserves. And in the United States, a claim on gold reserves. The U.S. had already gone off the gold standard when this statute was put in place. And you go back and look at some of the legislative history, and people were talking about a balance of payments deficit in a broader context. Ironically, one that included the risk that a whole bunch of people who had petrodollars could dump those petrodollars and try to get something else, like a liquidity problem. And then over time, I think in general, and this is how the Trump administration defined a balance of payments deficit, has become the current account deficit. So which sustain a trade deficit, a balance in income, payments, et cetera, et cetera. Now, since this was not defined by Congress and there is no consensus on how you cut and divide the balance of payments to determine what constitutes a deficit, the question is in some sense, could the courts intervene in a international economics debate which has on one side those who say, well, a balance of payments deficit is basically a current account deficit. The U.S. clearly has one, is actually decent size. Or will the courts side with those who say, if you're not intervening, the financial account always balances the current account, and there's plenty of money coming in to finance the U.S. current account, so therefore there is no balance of payments deficit. There's no deficit in payments. And if you want to focus on a payments problem, the question becomes, given that the dollar is pretty strong, given that there's plenty of demand globally before recent events for U.S. equity, for U.S. debt, can you call this a payments problem? My gut is that the courts are not going to want to weigh in on these debates. I personally don't think we have a payments problem. I personally think our balance of payments defined as a current account deficit is a bit on the high side, and we should worry about the fact that it will trend higher. So I come out kind of in between.
Brad, I'm glad I'm just a lawyer and you're the economist because, I try to make sense of it and I'm not sure I can. But I think that may just reinforce the fact the courts are going to want to stay out of this particular
we really could
debate.
do an entire episode on how the definition of a balance of payments problem and deficit evolved between 1965 and 1985. Because it turns out, I didn't know this, there was a lot of flux in the definition of a balance of payments deficit at the time when the Bretton Woods system collapsed, which is precisely when this statute was written. And when the concept was in flux and Congress didn't define what they meant by it, it does feel like a high hurdle for the courts to impose a definition.
Now, I know we just have a minute or two left, and I really want to thank you guys for your time. But in the closing minute or two that we have, there's been some reports in the press just today that we might be getting new product-specific tariffs. There's reports we might fairly soon be getting tariffs on pharmaceuticals, or at least on some pharmaceuticals, because it's in the press when we're recording this. There aren't really a lot of details. And then there have been some reports in the press we might be getting some adjustments to the steel product regime, less around sort of slabs, tariffs on slabs of steel coming in, but more around products that have some steel embedded in them. And just one sort of closing question to each of you, what are you expecting out of the administration on trade issues over the coming weeks to couple of months, which could include these things we're seeing in the press, but other things you might see coming out of the administration or think to see coming out of the administration? Maybe, Brad, I'll start with you, and then Greta, I'll give you the last word.
I think I'm looking at the most is what happens out of the summits with China. I think that's, from a structural point of view, that could lead to the most important evolution. Maybe not in tariffs, but in policy. Otherwise, I think the administration is in a mode where it is generally looking, and I think it actually may struggle, but we can discuss that at a later time, because some of the 301 overcapacity cases, like on Norway and on Germany for overcapacity in chemicals, when the reason why it has overcapacity in chemicals is because they've lost market share to China like everyone else. Some of those analytically seem pretty flimsy, but who knows? I mean, they're in a mode where they want to replicate what they had in general, not add to. The pharma case tariffs, I think, will be interesting because there have been a lot of deals, quote unquote, in the pharma space. And so most of the big American pharmaceutical companies have done deals which involve participating in Trump RX and have it as a counterpart, a commitment not to tariff their production, their imports, while they make some investments in the U.S. The investments haven't been well specified. So some may just be fill and finish, some may be production of active ingredients. But in general, the big companies have already pre-negotiated exclusions. So I'd be surprised if those deals are torn up. With the pharma tariffs, we may end up with something that looks very much like a tariff on an individual company. Because, generics are off the table. That's been clear for a while. And for patent-protected medicines, there's a company that has the patent, and you can specify that product in the tariff code. And so either you have a deal where you have an exclusion or you don't. So it may be a mechanism for pressuring those subset of companies, which haven't yet done deals with the Trump administration. Conceptually, I find it the most interesting of tariffs because there's a bigger question about incidence. When the price of an imported drug is like 10 to 100 times its production cost. And the reason why patent-protected pharmaceuticals are being imported from places like Ireland, Switzerland, and Singapore is because of the tax implications. So you could have a situation where this has a bigger implication on pharmaceuticals' tax strategies than it actually has on patterns of trade.
Greta, over to you. What are you expecting? And a last word.
Yeah, well, thanks so much. I agree that the China relationship and how that evolves over the year is super interesting and really important. And, it has implications. We saw after the first Trump administration, it has implications for how you move forward as a country, even if you have a change in political leadership. So really, really very important. And sort of on a macro level, I see restraint until the midterms as being a continued pattern, and maybe even more so than what we've seen so far. Pharmaceuticals is interesting. What we've seen with the 232s, in addition to, no real new tariffs and, for the critical mineral 232 that wrapped up, maybe some limited tariffs as a result of the semiconductor 232, but it was sort of hard to tell what that would even apply to. And they're also coming out later and later in the cycle of when the 232 sort of deadlines loom. So the actual deadline for the president to make a decision was now last month, and they're kind of running up on the last possible day to announce it in about a week or so, a week and a half. So I think you're just seeing more of this restraint, even as some of these actions have to come out because the statutory timelines are tolling. I agree with Brad, that I think that what we'll probably see with this 232 is something that is more about enforcing the company deals than about sort of any other part of what could be a pharmaceutical trade policy. And so that will continue to, maybe give a new impetus for more deals with more companies, covering more drugs, getting them onto the Trump RX website. But it will be interesting to see what they do. There's more 232s still out there. There's robotics and manufacturing equipment. There, maybe changes to other tools. I just am skeptical that we're going to see anything really big on, new tariffs, at least until after we get past the midterms.
Well, I think that's a great place to leave it. Greta and Brad, really appreciate you coming on the Security Economics podcast.
Thank you so
Well,
much.
thanks a lot. It's great to see you both.
And that's a wrap. I'd like to thank Brad and Greta for coming on the podcast, and I'd like to thank all of you for listening. Please leave us a review if you like the podcast, and please feel free to reach out anytime if you have things you'd like us to cover in a future episode or feedback on this one. Email line is always open. Just feel free to send me a note. It is PHARRELL@gmail.com. Keep it simple. Take care.